Hi, I am Matthew. Welcome to this video on Forex trading, where we will be discussing the various strategies and risks involved in the exciting world of currency trading. Forex trading can be a rewarding activity, but it also involves risks that traders should be aware of. By the end of this video, you will have a better understanding of the strategies and risks associated with Forex trading and be better equipped to make informed trading decisions. What is Forex trading? Forex trading is the act of buying and selling currencies in the foreign exchange market. The foreign exchange market is the largest financial market in the world, with a daily turnover of over $6 trillion. The Forex market is decentralized, meaning there is no physical exchange where traders meet to buy and sell currencies. Instead, all trading takes place electronically over the counter. How does Forex trading work? Forex trading involves buying and selling currency pairs. A currency pair is a combination of two currencies, such as the euro to US dollar or the US dollar to Japanese yen. When trading Forex, you are essentially betting on the direction that a currency pair will move. If you think that the value of a currency pair will increase, you would buy that currency pair, and if you think that the value of a currency pair will decrease, you would sell that currency pair. Factors that affect Forex trading. There are several factors that affect Forex trading, including economic news, geopolitical events, and central bank policies. Economic news, such as the release of employment data or GDP figures, can have a significant impact on currency values. Geopolitical events, such as elections or natural disasters, can also affect currency values. Central bank policies, such as interest rate changes or quantitative easing programs, can have a significant impact on currency values. Forex trading strategies. There are several Forex trading strategies that traders use to make trading decisions. Some of the most popular strategies include technical analysis. Technical analysis is a popular Forex trading strategy that involves using charts and technical indicators to identify trading opportunities. Technical traders believe that historical price and volume data can help predict future price movements. Technical analysis is used to identify trends, support and resistance levels, and other price patterns that can help traders make trading decisions. Traders use various technical indicators, such as moving averages, RSI, MACD, and Bollinger Bands, to analyze price movements and make trading decisions. Fundamental analysis. Fundamental analysis is another popular Forex trading strategy that involves analyzing economic data and other factors that can affect currency values. Fundamental traders analyze economic indicators, such as GDP, inflation, and employment data, to determine the strength of an economy and the potential impact on its currency. They also consider geopolitical events, such as elections and natural disasters, that can affect currency values. Fundamental traders use various tools and techniques to analyze these factors and make trading decisions. Price action trading. Price action trading is a Forex trading strategy that involves using price patterns and other price-related information to make trading decisions. Price action traders believe that the price movement itself is the best indicator of market sentiment and that it reflects all the relevant market information. Price action traders use various price patterns, such as candlestick patterns, chart patterns, and trend lines, to identify trading opportunities. They also use various price-related information, as support and resistance levels and pivot points to make trading decisions. News trading. News trading is a Forex trading strategy that involves trading based on economic news releases and other news events. News traders believe that economic news releases can have a significant impact on currency values and that trading based on these releases can be profitable. News traders use various tools and techniques to analyze economic news releases, such as the economic calendar, to determine the potential impact on currency values. They also use various trading strategies, such as breakout trading and fading the news, to make trading decisions. Scalping. Scalping is a Forex trading strategy that involves making many small trades throughout the day to capture small price movements. Scalping traders believe that small price movements can be profitable if they are traded frequently enough. Scalping traders use various tools and techniques, such as short-term technical indicators and order flow analysis, to identify trading opportunities. They also use various risk management techniques, such as tight stop-loss orders and position sizing, to minimize the risks associated with scalping. In conclusion, Forex trading involves various strategies and risks that traders should be aware of before they start trading. Traders should choose a strategy that suits their trading style and risk tolerance and should use proper risk management techniques to minimize the risks associated with trading. By understanding the risks and rewards of Forex trading and developing a solid trading plan, traders can increase their chances of success in the Forex market. Thank you for watching this video on Forex trading. We hope that you have found it informative and useful. Remember that Forex trading can be a high-risk, high-reward game, and it is important to approach it with caution and a solid trading plan. If you have any questions or comments, please leave them in the comments section below. Don't forget to like and subscribe to our channel for more informative videos on Forex trading and other financial topics.